Welcome back from your holidays. We're back as well, and we are still with our Outlook 2015 coverage. And joining us this Monday is Puru Saxena of Puru Saxena Wealth Management based in Hong Kong. Puru, good to see you again.
My pleasure. Daniel, always a pleasure to talk to you.
So Puru, the last time we spoke was, believe it or not, 2 years ago, and you were quite bearish on the metals. Now here we are concluding 2014, about to start 2015. How do you see the scenario set up here for gold and silver?
Well, I think we're in a bear market, and we are now 3.5 years, just over 3 years into a secular multi-year bear market. I think prices are going to go lower. I think gold is going to go lower. Silver has been going lower. As you know, we turned bearish on the metals roughly 3 years ago. Fortunately, we called pretty much the top, and we've been bearish ever since. And I think that the trend is down, the path of least resistance for the metals and commodities and oil. They're all headed lower, and the dollar, in my view, is going higher.
Puru, would you say that's the reason behind your bearishness? It's because you're so bullish on the US dollar?
Well, I think if you look at the world's currency markets, Daniela, you will note that the ECB is about to print money. The Japanese are printing money. The Fed has just ended its QE program, and contrary to many people's expectations, the dollar hasn't actually gone down. It's appreciated significantly, and especially more so since summer. And we are now at a very key technical level on the US dollar index, which is around the 89 level. And I think once that is taken out, we are going to see a very sharp rally in the US dollar, perhaps to over 100 on the US dollar index. And as you know, commodity prices are inversely correlated to the US dollar because commodities and precious metals are denominated in the greenback. And if the dollar rallies, then you're going to have a significant headwind against the metals, against the commodities. And moreover, if you look at the world's aggregate demand, the world's economy is not doing very well, as you know. And that, again, reduces the demand for natural resources at a time where production is doing pretty well. So you've got the twin factors of not enough demand and a rising dollar, which is really hurting commodities and precious metals.
Now, about 2 years ago, famed economist Nouriel Roubini was claiming that gold would hit $1,000 by 2015. So, Puru, when you're speaking about low levels, are those the same type of levels you're eyeing for 2015?
Well, I could go lower, Daniela. Remember, it went from $255 an ounce all the way to $1,900. Now we are trading just under $1,200. In a bear market, you know, the surprises happen to the downside. And once the 1,000 level's gone, then we could test the lows recorded in 2009, late 2008, early 2009. And silver, to me, looks even more vulnerable. It wouldn't surprise me if it falls below $10 an ounce. So I would stay well clear of the metals. We haven't had any positions in the metals for 2.5, 3 years now. I think the mining industry is also headed for major trouble because they've basically taken on projects which are only profitable at much higher prices.
More dire than this, Puru? They're already in such a troubled situation.
Oh, it's going to get much worse, Daniela. If the price of gold goes down below 1,000, you're going to see a lot of bankruptcies in the junior mining space. Already the stock prices have plummeted. And I think, whenever you have a big bear market in any industry, the big companies make it through, but a lot of the smaller companies, the marginal producers, go bankrupt. And I think you've seen nothing yet in the mining industry.
So, Puru, what would it take for you to get back into gold? Which levels? Don't you see it as a buying opportunity?
Well, I don't like to catch falling knives. They tend to hurt you. And one thing I have learned from this business, in the trading and investment management business, I try and swim with the tide, Daniel. I don't like to swim against the tide because you don't really go anywhere. You just fight against the strong current. And at the moment, the current or the trend is down for precious metals. How low they're going to go is anybody's guess, and how much the dollar is going to spike is anybody's guess. So I'll have to watch the price charts very carefully and then determine when this thing is topping out on the US dollar index and when the precious metals are showing some signs of basing out. At the moment, they aren't showing any signs of bottoming out. And if you look at the gold mining indices, the HUI and the Philadelphia Gold Index, they're all looking pretty vulnerable to me. So I would stay well clear of the precious metals unless you want to short them and make some money on the downside.
All right, Puru, let's look at stocks for a second. And in a recent article you wrote, you cautioned investors to really only be eyeing strong stocks and industry groups. Why is that? And do you think investors are a little ahead of themselves here?
Well, a lot of the industries are basically already topped out. If you look at the stocks traded on the New York Stock Exchange, and at my firm, Daniela, we track over 1,000 stocks on a daily basis, just the price charts. And a lot of the industry groups have already peaked out for this bull market. But there are certain industry groups which are still doing reasonably well. You know, the airlines, the autos, the auto parts, the dealerships, asset managers, biotechnology, healthcare, industrials, transportation, the railroads, retailers. These are some of the things which are still performing quite well. And the restaurant stocks have done really well because the commodity prices have come down. So if you stay with the leading stocks in the strong and favorable industry groups, then you think you can still participate in this bull market in equities. But if you try and catch falling knives and try and swim against the tide, this is not the way to invest. It's certainly not in today's environment.
Puru, you also recently said that you wouldn't be surprised if oil kept falling. Are you sticking to that?
Yeah, I think it will. I mean, it's already gone to almost 55. You know, it was almost 100, 110. And with the strong dollar, the price of oil is also getting hurt. And there is no demand for oil as much as it was maybe 2 years ago. The demand growth is very low. And you've got extra production coming in from the shale and fracking industry in the US. So again, it's a classic case of enough production, not enough demand, and the rising greenback, which is hurting the price of oil.
Puru, thanks so much. And finally, is there anything that you are really liking these days?
Well, I do like equities. You know, as I mentioned, some of the sectors in the US, they look quite interesting. I'm largely quite positive on the developed world for the next 3 to 4 years. I think equities in the US, in Europe, and in Japan are going to outperform the emerging markets by a long shot over the next 3 to 4 years. Having said that, we also have exposure to Indian equities. We've been long India for the last several months. And about 2 months ago, we've gone into the Shanghai Composite A shares. So we've finally turned bullish on the Chinese stock market after many, many years. I think the Chinese stock market may be the star performer over the next 12 months. So your listeners and viewers should probably try and get some exposure to the air shares in Shanghai.
All right, Puru, that's all the time we have left. Thanks so much for joining us for the Outlook 2015.
My pleasure, Daniela. Always a pleasure.
And thanks for watching our coverage. We'll have more for you in the next few days, and we hope you continue to enjoy the holiday season. In the meantime, you can email us any comments or questions at newsfeedback@kitco.com. Thanks for watching.